One of the best ways to consistently make money trading is to understand the facts and nuances about the market structure. Today we'll cover an important pattern, the over and under break of structure pattern. So if you could, like, subscribe to the channel, and stick around for the full video. Market structure is simply the support and resistance levels on your charts, determined by the swing highs and lows. These are the levels on your chart that attract the most attention. When the market is in a bullish trend and buyers are controlling the market, you will see higher highs and higher lows. There is a strong buying pressure. This results in the upward movement of the price with time. The formation of consecutive lower lows and lower highs in the price is referred as a bearish trend. This indicates a strong selling pressure. This results in a downward movement of price with time. Now, the over and under pattern represents a break of structure in the market. The break of structure is the first sign that the market is telling you that it's about to get weaker or it's about to reverse. Let's say we have an uptrend, higher highs and higher lows. We have a break of the structure when the price makes a new lower low and a lower high. This tells you that this trend could be weakening or it could reverse. For a downtrend, the same concept, lower lows and lower highs. We have a break of structure when the price makes a new higher high and a higher low. There's no guarantee that the trend is over, but this is a warning sign, a sign of weakness in the previous downtrend. We can distinguish two types of the pattern: the bullish break of structure, which appears at the end of a downtrend, and the bearish break of structure, which appears at the end of an uptrend. Here's how to easily find the bullish over and under pattern after a previous downtrend. Price creates a lower low. Price then creates a lower high. Price breaches the lower low and creates a new lower low. Then price breaks the previous high as well and forms a higher high. When price returns to the zone created by the two previous lows, you look to enter into a long position. For a bearish over and under pattern after a previous uptrend, price creates a higher high. Price then creates a lower high. Price breaches the previous high and creates a new higher high. Then price breaks the previous low as well and forms a lower low. When price returns to the zone created by the two previous highs, you look to enter into a short position. Now, you might be inclined to believe that this break of structure pattern looks similar to the head and shoulders pattern. The main difference between the over and under pattern and the head and shoulders pattern is the second valley of the over and under formation, which is much lower than the first valley. And this is a more common pattern than the classic head and shoulders because it involves two traps set by the smart money for both sides. The second major difference between the two reversal patterns is the entry point. Usually, the point of entry for the head and shoulders pattern is the break of the neckline, but with the over and under pattern, we look for a much earlier entry near the left wave, which offers a bigger profit potential. We'll talk about this later. So, why is this break of structure pattern important? For big institutions with a need to fill large orders, finding pockets of liquidity is absolutely essential. When these big players take positions in the market, they obviously aim to be filled at the best possible prices. However, given the size of their positions, they need to find enough counter forces to fill their orders with a minimal amount of slippage. If a big player were to enter the market at an area of low liquidity, the volatility it would create would have a negative impact on the average price it gets. Lower liquidity usually results in a more volatile market and will cause prices to change drastically. So where do we find these levels? Where stop-loss orders are placed? Where do you think the concept of stop-loss hunt comes from? From the necessity that large players have to enter the market in areas of liquidity as they aim to accumulate major positions. These areas will attract interest because that's where pockets of liquidity exist. Now, very important, the creation of a liquidity level comes as a result of an initial imbalance of supply and demand, which forms what we know as a swing high or low. As more players take positions in the market, these are the levels where market participants will use as a historical reference to place their stops. In a bearish over and under pattern, the highest high in the formation represents the liquidity hunt. Lots of traders had their stops placed above the previous swing high. Smart money pushed the price above the previous high, grabbed the liquidity, and moved price back down. I always like to see a clear rejection that leads to a structure breakout. And not only the previous higher high was broken, we also have a breakout of the previous lower high. Another liquidity hunt, because the price is then moved upwards toward the previous higher high. As a retail trader, it's very hard to make money in this context if you don't know what you are doing. The best time to trade the break-off structure pattern is after a significant rally or a sell-off, no matter the time frame used. You can use this on the daily chart down to the 1-minute chart. Here are the rules for a short signal during a bearish break-off structure. A prevailing uptrend needs to be visible with series of higher highs followed by a series of higher lows. Then we have the break in the market structure. Price starts to make a lower low. You plan to enter at the zone between the right wave and the highest high. You place the protective stop loss above the last higher high and the take profit near the first valley at the low of the first downleg, and the second target at the area of the lower low. For a bullish break-off structure, meaning for buy signals, a prevailing downtrend needs to be visible with series of lower lows followed by a series of lower highs. The break in the market structure, price starts to make a higher high. You plan to enter at the zone between the right wave and the lowest low. You place the protective stop loss below the last lower low and the take profit near the first peak of the pattern and the second target at the area of the higher high. The break-off structure don't always result in a reversal. That's why you need to find other confluence factors to increase the odds in your favor. Because with this pattern, I'm basically trying to align my positions with the smart money. Using supply and demand zones is a great way to find entry locations. So the plan is to find the break-off structure pattern. We'll wait for a retracement back to the first wave, and we'll try to find a supply or a demand zone for an entry to execute the trade with a greater accuracy. Here, a significant drop has occurred. The market makes an obvious low, followed by a lower high. Then, after making a lower low, it shoots up and bridges the previous high to make a higher high. The space between this low and the second low is considered as a strong demand zone itself. But what if you want even more accuracy? What if you are seeing the pattern on the hourly chart and you want to time your entry on the 15-minute chart or on the 5-minute time frame? You need to find the demand zone for an entry. First, you need to take a look at the left-hand side of the previous low where the strong rally has started. Now you need to find out the origin or the start point of that strong rally. Remember that demand zones are found when the market makes a large move up from a single candle or from a base. You always draw the demand zone from the last bearish candle before the up move. When price returns to the zone, you can open a buy position with stops below the lowest low. Here's our first target, and here's our second target. Of course, anticipating a much bigger break-off structure, you can leave a portion of the trade open in the case the reversal is much more aggressive. Here's another break-off structure, a bearish one. The price is forming a new high level, declines, then forms a temporary low. Prices then rally again to exceed the previous high, making a higher high. The price then falls to form a new lower low. This is our first sign that we might have an over and under pattern. Prices rise again to the initial high level, so we need to find a supply area. You look at the left side of the previous high, where the previous strong down move started. After that, you need to find out the origin of the strong down move. Remember, supply zones are found when the market makes a large down move from a single candle or from a base. You draw the supply zone from the last bullish candle before the down move. This is the price area that could represent the entry trigger. Stop level can be placed above this higher high, while partial profits can be taken at this low and at this low. Another effective way to trade a break of structure is by using indicators, more specifically, to find divergences between an indicator and the price. If that coincides with a supply or a demand zone, it gives you even a better indication of which way the price will go. Divergence is when the direction of a technical indicator, usually some form of an oscillator, MACD, RSI, stochastic, diverges from the overall price trend. In other words, the indicator starts moving in the opposite direction to the price, and the trading oscillator signals a possible trend reversal. Coupled with the initial break of structure, you have two indications that something will happen in a market. Bullish divergence is when price is moving lower, but the indicator turns and points up. Bearish divergence is when price is moving higher, but the indicator points down. The logic behind divergence to analyze the market is that the indicator is showing a slowdown in price momentum. Price momentum will often change before the price itself, and that's a leading signal. So the plan is to find a break of structure. We wait for price to return to trap new traders, and we want to find the divergence at the third wave in the structure. Here's a bearish break of structure with a stochastic divergence confirmation. Price makes a new high, declines, and makes a new low. Price then rallies above the previous high to mark a new higher high. Price then falls quite aggressively to form a new lower low. This is our break of structure. Price then rises towards the initial high, but doesn't make a new higher level. And during the up move after the break of structure, we have a bearish divergence on the stochastic. This bearish divergence signifies a potential down move because prices rally to a new high while the oscillator refuses to reach a new level. In this situation, bulls are losing their grip on the market, so a sell entry here is a high probability trade with an excellent risk-to-reward ratio. The protective stop loss above the last higher high, and the take profit near the first valley, and the second target at this low. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.